You know, it's almost impossible to picture, but back in, 2002, the total value of these things called traded derivatives, it hit $165.6 trillion.
Wow.
Not millions, not billions, trillions. It's a number so huge it's kind of hard to even wrap your head around.
Yeah.
Really gives you a sense of the sheer scale of modern banking.
It absolutely does. And you're right, for a lot of us, the world of finance, banking, it can feel incredibly complex, maybe even a bit intimidating,
Yeah, definitely.
even though it's basically the bedrock of how our modern economies function.
Exactly. And that's really why we're doing this deep dive today. We've tailored it specifically for you, our listeners. Our mission is to take the info from our source material, modernbanking.pdf, and kind of boil it down.
Yeah, get to the essential insights.
What banks fundamentally are, what they actually do,
Yeah.
and some of the major shifts and innovations that are shaping their future.
Think of this as your shortcut to understanding what really matters in banking today. We'll kick things off with the core jobs of a bank, what they do day to day, and how banking systems look different around the world. Then we'll definitely need to tackle this crucial idea of systemic risk.
Ah, yes, the domino effect.
Precisely. And the vital role central banks play in, well, trying to prevent that.
Right. And from there, we'll look at how banks have, expanded their reach into all sorts of areas.
Like those derivatives you mentioned.
Exactly. And how they navigate the tricky waters of international finance. We'll also explore how banks manage all the various risks they face, and there are a lot.
Oh, indeed.
And then dive into the really important world of banking regulation, both here and across the globe.
And finally, we'll touch on banking in emerging economies. And crucially, what we've learned, or maybe should have learned, from financial meltdowns in the past.
Sounds like a plan. Ready to get started.
Absolutely. So let's begin with the most basic question. What is a bank, really, at its heart?
Good starting point.
Our source material really emphasizes that they are fundamentally intermediaries. Think of them as go-betweens.
Go-betweens
Yeah.
for savers and borrowers.
Exactly. Connecting people who have money to save with those who need to borrow. And crucially, they also pump liquidity into the economy.
Right, liquidity.
Yeah.
Making sure there's readily available cash and credit. That's key, isn't it?
It's absolutely vital. It's not just about storing money.
They're not just vaults for our cash. They're actively connecting funds with opportunities. And it's fascinating how this core function sort of naturally leads to something else we often don't even think about.
Does.
How we actually pay for things, the payment system.
Precisely, yeah. As banks handle all these transactions between their customers, they automatically create a system for moving money around. It's essentially, transferring ownership of funds.
And the volume is just staggering.
It really is. Just think about the sheer volume. In the UK, back in 2001, there were over 28 billion cash payments.
Billion, with a B.
Yeah, and even though that was expected to drop a bit by, say, 2010, it's still a massive number.
Wow.
And get this, in the year 2000 alone, people in the UK pulled out 113 billion from ATMs, alongside making 3 billion transactions using their cards.
Those numbers really bring it home. And when we're talking about bigger sums, the payment systems get even more, sophisticated.
For sure.
Yeah.
Take, for example, the UK's CHAPE Euro system.
Chapey's Euro. Okay.
What's interesting about CHAPES is that it's designed for large, urgent payments. Think big corporate deals, house purchases, that sort of thing, and it settles them in real time.
Real time, so almost instantly.
Pretty much, which significantly reduces the risk that, one bank will be left hanging if another fails to make good on their payment during the day.
Ah, okay. That makes sense. So it lowers that settlement risk we mentioned.
Exactly. And that's a big difference from bulk payment systems like BACS, which process payments like salaries or direct debits in batches at specific times of day.
So different systems for different needs and different levels of risk tolerance, basically.
Spot on. And when we look at how banking is organized around the world, there's a real variety, isn't there? It's not one size fits all.
Definitely not. Canada, for instance. The source mentions it has a system maybe somewhat similar to the UK.
Yeah, in terms of concentration, you have a few very large banks holding the lion's share of deposits and loans. They do have credit unions and the Caisse Populaires in Quebec, but their overall market share is relatively small compared to the big players.
Okay. Then you've got countries like France and Germany where cooperative banks seem much more prominent.
Exactly. That cooperative movement is a really significant feature, particularly in retail banking. And Germany also has quite a number of smaller regional banks, the Sparkassen and so on.
So a bit more competition at the local level, perhaps?
Potentially, yeah. It provides a bit more competition to the large universal banks like Deutsche Bank, though, of course, those big players still hold substantial market shares nationally.
And then if you look at the U.S., historically, it's been a much more fragmented system, right? Spread out.
Very much so.
Yeah.
And a big reason for that was regulation, specifically things like the Glass-Steagall Act.
Ah, the famous one. Keeping commercial banking separate from investment banking.
Right. Commercial banks, the ones taking deposits and making loans to everyday businesses, were kept separate from investment banks, which deal more with, stocks, bonds, underwriting securities.
And there were also rules about branching across state lines.
Yeah, restrictions on interstate branching. Those rules really shaped the American banking landscape for decades, leading to a much, much larger number of smaller banks compared to, say, Canada or the UK.
But that changed.
Well, yes. The reforms of the 1990s were aimed at dismantling some of those barriers, encouraging banks to consolidate and potentially create truly national banking networks.
Okay, so banks are the middlemen. They provide the grease for the economic wheels by supplying liquidity.
Good analogy.
And they're the infrastructure for how we pay each other. And kind of overseeing this whole complex machine, you have the central banks.
Yep. Their main job, fundamentally, is to keep the financial system stable. One of their primary tools is monetary policy.
Right, controlling the money supply and interest rates.
Exactly. They use those levers to try and keep inflation under control, aiming for price stability.
We see that in action with the Bank of England, right? They have a specific target for inflation they have to aim for.
They do.
Yeah.
And in some places, like New Zealand, getting that inflation target right is taken very seriously. The source notes that the head of the central bank's compensation, even their job, can be linked to hitting that target.
Wow. Talk about accountability.
Indeed. Now, what's fascinating and also a bit scary is how the interconnectedness of all these banks creates what we call systemic risk.
Right, the domino effect I mentioned earlier. If one big bank gets into serious trouble.
It can create a chain reaction, destabilizing the entire financial system. Contagion, they call it.
And the consequences of that kind of widespread collapse, they're really severe, aren't they?
Extremely. The source material even suggests it could grind the economy to a halt. Payments stop flowing, credit dries up, potentially forcing us back towards, like, a barter system.
Yikes. Okay, so that's the nightmare scenario.
It is, but it highlights why governments tend to treat banks as special.
Yeah.
They're just too critical to the economy to let them fail in a disorderly way.
And that's where central banks come in again, acting as the lender of last resort.
Exactly. Providing emergency funds to banks that are fundamentally sound, but just facing a temporary cash crunch, a liquidity problem. We also sometimes see lifeboat rescues.
Lifeboats.
Yeah, where stronger banks are sort of encouraged, maybe even pressured by regulators to take over or help out struggling ones to prevent a bigger crisis.
But this safety net, while it might be necessary sometimes, it also creates that tricky problem we talked about earlier, moral hazard.
Bingo. That's the downside.
Yeah.
If banks, especially the really big ones, believe they'll ultimately be bailed out if they make really bad bets and lose a ton of money.
It encourages them to take on more risk than they otherwise would.
Precisely. The whole idea of too big to fail, where certain banks are just seen as needing rescue no matter what to avoid wider economic damage, really complicates this. It potentially incentivizes these massive institutions to engage in even riskier behavior, knowing there's likely a government backstop.
It's a real tightrope walk for regulators, isn't it? Balancing stability with market discipline.
Absolutely. Now, beyond these core roles of intermediation and liquidity, the banking world has become incredibly diverse. Banks aren't just about savings accounts and mortgages anymore.
Yeah, they seem to do everything these days.
Well, maybe not everything, but we've definitely seen a significant expansion of what banks do. They've moved into areas like real estate services, helping people buy and sell property.
Stockbroking.
Yep, stockbroking, allowing people to trade shares, and even insurance. It's led to different types of banks emerging. Well, you have specialist banks focusing on particular niches, generalist banks offering a wide array of services, private banks catering to wealthy clients, investment banks helping companies raise money, and then these universal banks that try to be a one-stop shop for pretty much all financial needs.
And this expansion isn't just happening within countries, right? Global banking has grown enormously.
Hugely. The international trade of banking services, banks operating across many borders, these are major trends.
And speaking of complexity and new frontiers, we absolutely have to talk about that phenomenal growth in the derivatives market you mentioned at the start.
Okay, yes. Let's break down what a derivative actually is. because the name sounds complex.
It can sound intimidating, but think of it like a side bet. A derivative is essentially a financial contract whose value is linked to something else, an underlying asset.
Okay, linked to what kind of assets?
Oh, almost anything.
Right.
It could be a bond, a stock, a barrel of oil, a currency, even interest rates. The contract's value depends on what happens to that underlying thing at some point in the future.
And common examples are things like futures, forwards, swaps, and options. We can maybe unpack those a bit more later if needed.
Okay, and the sheer size of this market is just, well, mind-boggling, as I said.
Absolutely staggering. Our source points out that massive leap from, was it $2.6 trillion in outstanding traded derivatives in 1988
Yeah.
to $165.6 trillion by 2002. It's just exponential growth.
And a lot of this happened outside traditional exchanges.
That's a key point.
Mhm.
This growth has largely happened away from the organized regulated exchanges. It's
Yeah.
moved into what's called the over-the-counter or OTC market.
OTC, meaning deals made directly between two parties, like two banks.
Exactly. Private agreements negotiated directly,
Yeah.
which, offers flexibility but also potentially less transparency and maybe more counterparty risk compared to exchange-traded contracts where the exchange itself often guarantees the trade.
Right. That sounds like it could be a bit riskier, maybe. Less oversight.
Potentially, yes. Now, with all this increasing globalization, how have the systems for actually moving money across borders kept up, especially in places like Europe?
Good question. Has it been smooth sailing?
Not entirely. Integrating cross-border payments and especially settlement systems, the final confirmation of trades, particularly within Europe, has been a challenge. For example, the source notes that the cost of trading shares across different European countries has historically been much higher than doing similar trades within the U.S.
Why is that? Just different systems, different rules?
Pretty much. Lots of national fragmentation in the back office infrastructure.
Yeah.
There's a recognition now that having a central counterparty clearing system, an ECCP, for equities could save a lot of money.
A central clearinghouse. How would that help?
Well, the real magic of a central clearinghouse, or CCP, is this concept of netting.
Netting, okay.
By stepping in between the buyer and the seller in every transaction, the CCP becomes the buyer to every seller and the seller to every buyer. This allows banks to offset their purchases against their sales throughout the day.
Ah, so instead of settling every single trade individually.
Exactly. They only need to settle the net amount they owe, or are owed at the end of the day. This massively reduces the overall number of transactions that need final settlement, and, as a result, the amount of capital they need to hold tied up just for settlement purposes.
Makes sense. It's all about making the system more efficient and hopefully reducing potential gridlock and risks.
That's the goal. And as these global financial activities expand, we naturally see different financial centers competing to be, the top dog. London, for example, has historically been a dominant player.
Yeah, London's always been huge in finance.
It has, with significant advantages in terms of jobs, the volume of transactions, innovation. But other cities, like Frankfurt, are definitely looking to gain ground.
Why Frankfurt?
Well, being the home of the European Central Bank, the ECB, gives Frankfurt a real strategic advantage within the Eurozone. Plus, it has a pretty convenient time zone for linking Asian and American markets.
And New York, of course, has always been a major hub, right? Despite the regulators being in Washington, D.C.
Absolutely. New York remains a powerhouse, particularly for the North American time zone. The table in our source material is quite interesting, actually. It shows how the number of foreign financial firms setting up shop in these key cities shifted quite a bit between, say, 1970 and 2000.
So the landscape keeps changing.
It does. And it also touches on the struggles faced by specific national banking sectors in the global arena, like the difficulties Japanese banks had operating overseas in the late 1990s.
Why was that? Linked to problems back home.
Very likely, yeah. Linked to the big economic problems and the banking crisis they were experiencing domestically at the time.
Okay, so it's a constantly shifting, complex, and highly competitive global financial landscape. Now, with all this activity, all these diverse financial tools, effectively managing risk must be absolutely crucial for banks.
It's paramount. It's basically job number one after taking deposits and making loans. The preface of modernbanking.pdf actually gives us a really comprehensive list of the different kinds of financial risks banks have to grapple with.
Okay, let's hear them.
Right, so there's credit risk. That's the obvious one. This risk someone they lend to won't pay back.
The big E.
Then, counterparty risk. The risk that the other party in a financial transaction, maybe in that OTC derivatives market, will default before the deal is settled.
Okay.
Liquidity risk and funding risk, basically.
Yeah.
Not having enough cash on hand when you need it, or not being able to borrow it quickly.
Bank run risk again?
Yep. Settlements or payments risk problems with the actual process of paying or settling transactions. Market risk or price risk, that's losses due to changes in market prices, like stocks or bonds going down.
Got it.
Interest rate risk losses due to unexpected changes in interest rates affecting the value of their assets and liabilities. Foreign exchange or currency risk losses from fluctuations in currency values if they operate internationally.
Still going?
Almost there. Gearing risk that relates to how much they've borrowed relative to their own capital. Sovereign or political risks related to government actions or instability, especially in foreign countries. And finally, operational risk.
Operational risk? Like what?
Things like internal fraud, errors, system failures, cyber attacks. Basically, the risk of things going wrong in their day-to-day operations.
Wow. That is a lot for banks to worry about. Let's zoom in on a couple. That liquidity or funding risk sounds particularly critical for banks.
It really is. It's fundamentally the risk of not having enough readily available liquid assets to meet your immediate obligations, like depositors wanting their money back or needing to settle trades.
And it can happen even if the bank is technically solvent.
Absolutely. A bank might have valuable assets like long-term loans, but if they can't quickly convert them to cash or borrow against them, and suddenly a lot of depositors demand their money, that's a liquidity crisis.
Yeah.
As we discussed, providing liquidity is a core service of banks, so people need to have confidence they can access their funds.
Because if those rumors start spreading that a bank might be short on cash, you can quickly see a panic, a run on the bank.
Exactly. And if a bank can't quickly get emergency funds from the central bank or borrow from other banks, a liquidity problem can very rapidly turn into an insolvency problem, even if the bank's underlying assets were sound.
Scary stuff. Now, going back to derivatives for a moment, you mentioned different types like forwards, futures, options. Can you clarify the key difference there?
Sure, so forwards and futures are pretty similar in concept. The key thing with both is that you are obligated to buy or sell a specific asset at a specific price on a specific future date.
Obligated. So you're locked in.
Right. Whether you're hedging, trying to protect yourself against future price swings, or speculating, you're committed to that transaction unless you make another offsetting trade to get out of it.
Okay. And options are different how?
Options give you more, well, options. They give you the right, but crucially not the obligation, to buy or sell the underlying asset at a specific price that's called the strike price on or before a certain date.
Right, not the obligation, so you can choose not to do it.
Exactly. And for that flexibility, that choice, you pay a fee up front, which is called the premium.
Okay. So a call option gives you the right to buy.
Correct. A call option gives you the right to buy. And you typically only exercise that right, actually buy the asset, if the market price goes above your agreed strike price.
Because then you can buy it cheaper than the market.
Precisely. If the market price stays below the strike price, you wouldn't exercise the option, you'd just let it expire worthless. Your maximum loss in that case is just the premium you paid initially.
Got it. The source uses an example with IBM stock, right?
Yeah, buying a call option on IBM. If IBM's stock price goes above the strike price before the option expires, the option is in the money, and you'd likely exercise it. If it stays below, it's out of the money, and you probably just let it lapse. A put option, by the way, gives you the right to sell.
Okay, that makes sense. And then we have even more complex stuff like credit default swaps, CDSs.
Right. CDSs became particularly famous or infamous around the 2008 crisis. Think of them basically as a form of insurance against a borrower defaulting on their debt.
Insurance on a loan, how does that work?
So imagine Bank A lends money to, say, a company. Bank A might be worried about that company not paying back. So Bank A can buy a CDS from Bank B.
Okay.
Bank A pays Bank B a regular fee, like an insurance premium. In return, if that company fails to pay its debt, if a predefined adverse credit event happens, like bankruptcy, then Bank B compensates Bank A for the loss on the loan.
So Bank A effectively offloads the credit risk onto Bank B.
Exactly. It's a way to transfer credit risk from one party to another. Of course, then Bank A faces counterparty risk from Bank B.
Ah, the risk that Bank B won't be able to pay up if the company defaults.
Precisely. It just shifts the risk around. Now, what's the bigger picture impact of all these derivatives on the financial system?
Yeah, good question. Are they good, bad, neutral?
Well, the argument often made and mentioned in our source is that they've essentially unbundled different types of risk. They make risks more visible, more explicit.
Unbundled. What do you mean?
Instead of all the various risks, interest rate risk, credit risk, currency risk being sort of lumped together in the overall price of something like a loan. Derivatives allow you to isolate and trade each individual type of risk separately.
So you can price just the credit risk or just the interest rate risk?
Theoretically, yes, you can price them individually. And banks often promote these instruments to their corporate clients as tools for managing their own specific risk exposures, hedging fuel costs or currency fluctuations, for example.
That makes sense. Okay, so banks are dealing with all these risks using all these complex instruments. How do they actually try to measure and manage it all internally?
They use a range of tools and models. One important concept mentioned is risk-adjusted return on capital, or ROC.
ROC. Catchy. What is it?
Essentially, it's a way for banks to evaluate the profitability of a particular activity, or a loan, or a whole business line, relative to the amount of risk it involves.
So not just looking at the profit, but the profit compared to the risk.
Exactly. It compares the expected profit to the amount of economic capital they estimate they need to hold to cover potential unexpected losses from that activity. It helps them allocate capital more efficiently to the most profitable areas, considering the risks.
It's like asking, for every dollar of potential loss we're exposed to here, are we actually making enough profit to make it worthwhile?
That's a great way to think about it. Another really important tool, especially for managing market risk, the risk of losses from market price movements, is value at risk, or VAR.
VAR. Okay, heard of that one.
VAR is a statistical model. It tries to estimate the maximum potential loss a bank might face on a particular portfolio, say their trading book, over a specific period of time, like one day, with a certain level of statistical confidence, like 99%.
So a bank might calculate its VAR and say something like, we're 99% confident that we won't lose more than, say, $10 million in our trading portfolio tomorrow.
Precisely that. It gives them a single number that summarizes their potential short-term market risk exposure under normal market conditions.
Under normal conditions, that sounds like a key caveat.
It is. And our source rightly includes a caution from Nassim Taleb, famous for his work on black swan events. Taleb warns against relying too heavily on VAR because it's based on historical data and statistical assumptions that might break down during extreme market turmoil exactly when you need risk management the most.
Right, it might underestimate the risk of those really rare, really big losses.
Exactly, which is why the source also stresses the importance of stress testing.
Stress testing, like simulating disaster scenarios.
Pretty much. Stress testing involves looking at how a bank's portfolio would perform under extreme, even if seemingly unlikely, scenarios like a massive stock market crash, or a sudden spike in interest rates, or a major counterparty defaulting. As the quote from Jorian in the source highlights, stress testing complements VAR by forcing banks to consider the impact of hidden risks and really unusual severe events that VAR models might miss.
It's about acknowledging that statistical models have their limits and trying to prepare for those unexpected, maybe unprecedented shocks.
Couldn't have said it better. Now, shifting slightly, when a bank actually decides to make a simple loan, how do they figure out what interest rate to charge that borrower?
Yeah, what goes into that calculation?
Well, the basic formula, as outlined in our source, has a few key components. First, there's the current market interest rate, kind of the base cost of funds.
Like the central bank rate plus a bit?
Sort of, yeah, reflecting the bank's own funding costs. Then, crucially, they add a risk premium.
The premium based on how likely the borrower is to default?
Exactly. That reflects the specific credit risk of that particular borrower. And finally, they might add some administrative fees to cover their costs of processing and managing the loan.
Okay, market rate, risk premium, fees. And the source mentions an interesting relationship between the market rate and the risk premium.
Yes, it notes they often tend to move in the same direction.
Why would that be?
Well, think about it. If overall market interest rates are high, it might be because the general economic outlook is perceived as riskier, making defaults generally more likely. Or the higher interest rates themselves might put more financial strain on borrowers, making it harder for them to repay their debts, thus increasing their individual risk premium.
That makes sense. So if borrowing is generally more expensive, the extra bit charged for risk tends to go up too.
Often, yes. And to determine that specific risk premium for an individual borrower, banks increasingly use quantitative models. One key example is credit scoring.
Credit scoring, like the scores we hear about for consumers.
Exactly like that. But often, more sophisticated models are used for business lending too. It's about using data to predict how likely someone is to not pay back their loan.
How do they do that?
These systems analyze a borrower's past financial behavior, things like payment history, existing debts, and their current financial situation. They often use statistical techniques like discriminant analysis or Logi analysis to crunch that data and assign the borrower a score.
And that score reflects their probability of default.
Essentially, yes. It helps banks categorize borrowers into different risk buckets, which then informs the risk premium they charge, or even whether they approve the loan at all.
It's all about trying to quantify and manage the inherent uncertainties in the business of lending money. Makes sense.
It's a constant effort. Now, shifting gears a bit, all this banking activity, all these risks and models, it doesn't happen in a vacuum, does it?
Absolutely not. It's heavily shaped by regulation. What are the fundamental goals behind regulating financial markets and banks in the first place?
Our source highlights a couple of key aims. Firstly, it's about protecting investors, or in banking, depositors, making sure people have enough information about the financial products they're buying or the institutions they're trusting their money with, because the quality isn't always obvious up front. Information asymmetry, they call it.
Right, making sure people aren't getting ripped off or taking risks they don't understand.
Exactly. And secondly, it's about addressing the potential problems that arise when financial power becomes too concentrated in the hands of just a few large firms. It's about promoting competition.
We've actually seen examples of that competition concern in action, right? The source mentions some specific cases.
Yeah, like when the UK competition authorities blocked the proposed merger between Lloyd's TSB and Abbey National back in the day, or when Canadian regulators refused to allow mergers between some of their big banks, precisely because they were worried about too much market concentration reducing choice and potentially leading to higher prices for consumers.
So regulators are actively trying to maintain a reasonably competitive landscape.
They are. However, going back to that idea of banks being special and the existence of safety nets like bailouts and deposit insurance, that creates that moral hazard problem again, which complicates regulation.
Right. Deposit insurance, which protects depositors' money up to a certain limit,
Right.
and the whole too big to fail concept. They're meant to prevent crises, but they can have unintended consequences.
They absolutely can. They can unintentionally change the incentives for both the people who deposit money and, perhaps more importantly, the people who run the banks.
How so?
Well, depositors who know their money is insured up to, say, $100,000 or £85,000 might not bother to pay close attention to how risky their bank actually is. They feel protected regardless.
So less market discipline from depositors.
Exactly. And bank managers, especially at institutions that might be struggling financially, might be tempted to take on even bigger risks, a gamble for resurrection, knowing that if it pays off, they benefit. But if it fails, the deposit insurance fund, or potentially the taxpayer, will bear a large part of the cost, and depositors are protected. Too big to fail exacerbates this for the largest institutions.
It's a classic example of good intentions potentially leading to perverse incentives and negative side effects, a real headache for regulators.
It really is. Now, when we talk about specific international regulations designed to counter some of these risks, the Basel Accords are probably the most important ones to understand.
Basel, right. Basel I, Basel II. What was the main goal there?
Okay, so Basel I, back in 1988, was really the first major international agreement to set minimum capital requirements for banks. The main focus then was on credit risk.
So making sure banks had enough of their own capital, a buffer, to absorb potential losses if borrowers didn't repay their loans.
Exactly, setting a minimum cushion. But, the financial world keeps evolving, becoming more complex with risks beyond just traditional loans becoming more significant.
Like market risk from trading and those derivatives.
Precisely. So that led to the development of Basel II, which was a much more comprehensive and sophisticated framework. It extended those minimum capital requirements to explicitly cover other major types of risk, particularly market risk and also operational risk.
Operational risk, that was the fraud, errors, system failures category.
That's the one.
Huh.
So Basel II aimed for a more holistic view of the risks banks face, and the capital needed to back them up.
And Basel II also gave banks different ways to calculate how much capital they needed, right? It wasn't just one simple formula.
Correct. It introduced different approaches. There was still a standardized approach, which relied heavily on external credit ratings from agencies like Moody's or S&P, and used preset risk weights assigned by regulators.
Okay, a simpler option.
Yes. But then there were the more advanced internal ratings-based, or IRB, approaches. These allowed banks that had sophisticated internal risk management systems and got approval from their regulators to use their own internal models and data to estimate the credit risk parameters, like the probability of default for their borrowers.
So potentially a more accurate measure of risk for those banks.
That was the idea, yes.
Yeah.
To make regulatory capital requirements more sensitive to the actual risks banks were running. The timeline for putting Basel II into effect was laid out, with the standardized approach expected to be in place in major developed countries by the end of 2006, and the more advanced IRB approaches following about a year later.
And even when it came to market risk, Basel had a standardized approach for banks that didn't have their own fancy internal VAR models approved.
That's right. For banks using the standardized approach for market risk, it used what's called a building block method.
Building block.
Yeah. Banks had to calculate the capital they needed to hold separately for different categories of market risk, like interest rate risk in their trading book, equity risk, foreign exchange risk, commodity risk, and then they basically just added those amounts together.
So no accounting for diversification? Like if movements in bond prices might offset movements in stock prices in their portfolio.
Exactly. Under the standardized approach for market risk, it didn't explicitly recognize the potential benefits of diversification across different risk categories when calculating the regulatory capital charge. You just summed up the blocks. Internal models, however, could potentially capture some of those diversification effects.
So this brings up an interesting point. The amount of capital that regulators require banks to hold the regulatory capital isn't necessarily the same as the amount of capital a bank internally thinks it needs to cushion against unexpected losses, right?
Yeah. That's a crucial distinction. Banks also calculate what they call economic capital. That's the amount of capital they estimate, using their own internal models and risk assessments, that they need to survive potential unexpected losses over a certain time horizon with a certain degree of confidence.
So their own view of the necessary cushion.
Exactly. Ideally, one of the goals of the more advanced approaches in Basel II, like the IRB approach, was actually to try and bring regulatory capital requirements more closely in line with banks' own internal assessments of economic capital, to make the rules better reflect the underlying risk.
Okay. Beyond the big Basel framework, were there other ideas floating around for how to regulate banks, maybe using market forces a bit more?
Yes, the source mentions a couple of alternative or maybe complementary approaches that have been discussed. One is the idea of pre-commitment.
Pre-commitment, what's that?
The idea here is that banks would publicly state or pre-commit to the level of capital they plan to maintain over a future period. If they then subsequently fall below that self-declared level, they'd face significant penalties from the regulators.
Interesting idea, but potentially problematic.
Yeah, the source points out a potential issue. What happens during an unexpected major economic downturn? Banks' capital might naturally be depleted due to loan losses, and penalizing them further for falling below their pre-committed level might actually make the downturn worse.
Right, could be pro-cyclical. What was the other idea?
The other main one mentioned is requiring banks to hold a certain portion of their regulatory capital in the form of subordinated debt.
Subordinated debt, that's debt that ranks lower than other creditors, like depositors, if the bank goes bust, right? So the holders lose their money before depositors do.
Exactly. The thinking is that the investors who buy this subordinated debt would have a very strong financial incentive skin in the game to monitor the bank's risk-taking very closely. If the bank starts looking too risky, the price of its subordinated debt in the market should fall, sending a warning signal.
So using market signals from these debt holders as an early warning system for regulators.
That's the hope. But for this to work effectively, a few things are crucial. First, there needs to be a clear, credible understanding that these subordinated debt holders won't be bailed out if the bank fails. Otherwise, they won't have the incentive to monitor.
No moral hazard for the debt holders either.
Right. Second, the debt needs to be held by knowledgeable investors who can actually assess the bank's risk. And things like how long the debt lasts before it matures and how often new debt is issued are also important design considerations to make sure the market signal is timely and meaningful.
It definitely sounds like a tricky balancing act, trying to harness market discipline without creating new problems.
It is. Now, the way banking systems are structured and regulated also varies quite a bit around the world, as we touched on earlier. Let's maybe look a bit closer at the UK system first.
Okay, the UK.
The UK is often described as having a restricted universal banking system.
Restricted universal, what does that mean?
It means that while the big UK banks can generally offer a wide range of financial services, commercial banking, investment banking activities, insurance, sometimes they're generally discouraged by regulators from owning significant stakes in non-financial commercial businesses, unlike, say, the traditional German model.
Okay. And the market structure is quite concentrated.
Yes, the banking sector is dominated by what's often called the Big Four commercial banks, historically. HSBC, Royal Bank of Scotland Group, now NatWest, Lloyds Banking Group, which includes HBOS, and Barclays. There are other major players too, of course, like Santander UK. Interestingly, many of the traditional British merchant banks, the old city names, were actually bought up by foreign firms, mostly in the late 20th century.
Right. And we also saw that big shift with building societies converting into banks, didn't we?
Absolutely. That was a major change following the Building Societies Act of 1986. Many large building societies, which were originally member-owned institutions focused primarily on mortgages and savings, chose to demutualize.
We're giving up their mutual status.
Exactly. They converted into publicly traded companies, becoming banks. Big names like Abbey National, Halifax, Alliance, and Leicester all went down this route, which meant, of course, they then fell under the standard banking regulatory oversight of the Bank of England and later the Financial Services Authority, FSA.
And it's interesting that the source notes the UK didn't even have specific banking law before 1979.
Yeah, it's kind of surprising. Regulation was more informal, based on supervision by the Bank of England, but the secondary banking crisis in the mid-1970s really highlighted the need for more formal legislation and powers, leading to the 1979 Banking Act, which solidified the Bank of England's formal role as the primary banking regulator at that time.
Okay. Moving across the Atlantic, the U.S. has had a very different history of banking regulation, particularly with that Glass-Steagall separation.
Indeed. The Glass-Steagall Act, passed way back in the 1930s after the Great Depression, created that really strict separation between commercial banking, taking deposits, making loans, and investment banking, underwriting and dealing in securities for many, many decades.
But that separation eventually ended.
Yes, it was gradually eroded over time and formally repealed by the Gramm-Leach-Bliley Act in 1999. But its legacy profoundly shaped the structure of the U.S. financial industry for a very long time. Another key feature was the rise of bank holding companies, or BHCs.
BHC.
These are companies that own one or more banks. The holding company structure allowed banking organizations to engage in some other financial activities that weren't strictly considered traditional banking under the regulations at the time, offering a way around some of the restrictions. The regulatory environment in the U.S. has also historically been quite complex, with multiple regulators at both the federal level, like the Federal Reserve, the FDIC, the OCC, and the state level.
A lot of cooks in the kitchen, maybe.
Some would say so. And deposit insurance, provided by the Federal Deposit Insurance Corporation, the FDIC, has been an absolute cornerstone of the U.S. system since the 1930s as well.
Right. Insuring deposits up to a certain limit, currently $250,000 per depositor per insured bank.
Correct, although the limit mentioned in the source, $100,000, was the level for a long time. However, the FDIC itself faced huge challenges during the savings and loan S&L crisis of the 1980s. The insurance fund for the S&Ls actually went broke.
That was a massive crisis. What came out of it regulation-wise?
It led to some major regulatory overhauls. Key legislation included the Financial Institutions Reform, Recovery, and Enforcement Act, or FURA, in 1989, which restructured the regulatory agencies and created the Resolution Trust Corporation to deal with the failed S&Ls. Then came the Federal Deposit Insurance Corporation Improvement Act, or FDICI, in 1991.
FDICA, what did that do?
FDICA aimed to strengthen regulation significantly. It pushed for prompt corrective action, regulators intervening earlier when banks get into trouble, and required regulators to resolve bank failures in the least costly way possible for the Deposit Insurance Fund, trying to limit taxpayer exposure. It also mandated risk-based deposit insurance premiums.
Ah, so riskier banks pay more for their insurance?
That was the idea, yes, trying to counteract some of that moral hazard.
Okay. What about Japan and the European Union in terms of their regulatory landscapes?
Well, as the source indicates, details on Japan's regulatory history and structure are kind of spread out across different chapters, often discussed in the context of their big financial crises in the 1990s. We'll definitely circle back to that when we talk more specifically about those crises.
Makes sense. And the EU?
In the EU, there's been a long-term push towards harmonizing regulations and creating a more integrated single market for financial services. This includes adopting international standards like the Basel Accords across all member states and implementing things like the single banking license or passport.
The passport lets a bank authorized in one EU country operate in others without needing separate authorization everywhere.
Exactly, that's the principle. However, the source notes that creating a truly unified and seamlessly integrated banking market across Europe has proven difficult. National policies, like different tax treatments for financial products or subtle regulatory differences, can still create barriers that sometimes favor domestic lenders over foreign competitors operating within their borders.
So still some fragmentation despite the single market goal.
Yes, particularly in retail banking. It's interesting, the source draws a parallel with the U.S., noting that even within a single country like the United States, you historically saw significant fragmentation in areas like retail banking and insurance, even while the wholesale financial markets were highly integrated. So achieving full integration is hard.
And the source also points out that separation between monetary policy and bank regulation isn't universal.
Right. In many countries, the job of controlling the money supply and setting interest rates, monetary policy, is handled by the central bank, while the job of supervising and regulating individual banks might be done by a separate agency. The UK, for example, has gone through periods with separate bodies. The U.S., however, is mentioned as a notable exception, where the Federal Reserve has significant responsibilities in both monetary policy and bank supervision and regulation.
Okay, now let's turn our attention to banking in emerging economies. The picture there can often look quite different from what we see in, say, Europe or North America.
It often does, yeah. One key difference highlighted in the source is the extent to which foreign banks are allowed to operate. It varies hugely.
That's it.
While some emerging markets like Hungary, Mexico, and Kazakhstan are mentioned as having actively encouraged foreign banks to enter, seeing them as a source of capital, expertise, and competition. While others, like China before its WTO accession commitments kicked in around 2007, or Thailand before its financial crisis in the late 90s, had significant restrictions on what foreign banks could do, where they could open branches, or how much ownership they could have.
So, different levels of openness. What about Russia? It's been through huge economic transitions.
Russia has definitely seen some significant changes in how its banking sector is regulated, particularly aimed at strengthening the system. The source mentions stricter fit and proper criteria for who can actually own and manage a bank.
Trying to weed out dodgy owners.
Presumably, yes.
Yeah.
Also, the introduction of laws specifically designed to combat money laundering, which was a major concern, and importantly, a move towards adopting International Accounting Standards, or IAS, now known as IFRS.
Using international standards for reporting. Why is that important?
It increases transparency. It makes it easier for investors, both domestic and foreign, to understand and compare the financial health of Russian banks. Sberbank, the very large state-owned savings bank, is mentioned as being one of the early adopters of IAS.
Were there challenges in implementing those standards?
Yes, the source notes there were difficulties. Differences between the requirements of IAS and existing Russian law, plus a shortage of auditors experienced in applying these international standards, made implementation challenging. But overall, the push towards greater transparency is seen as a positive step.
And what about how efficient banks are in these economies that have been transitioning from centrally planned to more market-based systems? Has research looked at that?
Yes, the source cites a study by Gregorian and Manoli from 2002 that looked at bank efficiency in these transition economies.
What did they find?
They found a few key things correlated with higher efficiency. Banks tended to be more efficient if they were well capitalized, had strong capital buffers.
Makes sense, gives them stability.
If they had a larger share of the domestic market, suggesting maybe some economies of scale. And interestingly, if they had majority foreign ownership.
So foreign banks brought in expertise or better practices.
That's the implication, yes. It suggests that having a certain degree of consolidation, allowing banks to reach efficient scale, and bringing in the management expertise and potentially the technology that foreign ownership can offer seem to be beneficial for improving efficiency in those specific contexts.
What about China and India? Two huge emerging economies with massive banking sectors. Have they seen reforms?
Yes, both have. In China, the source mentions a trend towards widening the ownership base of the so-called joint stock commercial banks, bringing in more diverse shareholders beyond just the state. However, it also notes that the government, through state-owned entities, still maintains significant control over the banking system overall.
So reform, but still with strong state influence in India.
India's situation, particularly concerning its large state-owned banks, is described as facing ongoing challenges despite various reform efforts over the years. High levels of non-performing loans, bad debts, and generally lower productivity compared to private sector banks have been persistent issues. The source even uses the phrase destructive unambiguity to describe a perceived lack of clear, decisive government action at times.
Destructive unambiguity. That's quite a phrase. Okay, our source material also introduces the principles of Islamic banking. This is a really interesting and distinct approach.
It absolutely is. Islamic banking operates according to Sharia law, the principles of Islam. And one of the most fundamental principles is the prohibition of riba, usually interpreted as interest.
No charging or paying interest. How does a bank make money then?
Well, instead of interest-based lending, Islamic finance relies on different types of contracts. Two key ones mentioned are based on equity participation, like musharaka, where the bank and the customer contribute capital to a venture and share the profits and losses according to an agreed ratio.
So more like a partnership or venture capital.
In a way, yes. Risk sharing is a key principle. Another common method is asset-backed financing, like murabaha. Here, the bank buys an asset, say a machine or property that the customer wants, and then sells it to the customer at a pre-agreed markup, often allowing the customer to pay in installments.
Ah, so the bank's profit comes from the markup on the sale, not interest on a loan.
Exactly. These different models mean that Islamic banks face different types of risks compared to conventional banks, for instance. They might be more exposed to business risk and profit-sharing arrangements. They also have different approaches to ensuring financial safety and soundness.
Are there specific bodies setting standards for this sector?
Yes, the source mentions organizations like AAOIHFI, Accounting and Auditing Organization for Islamic Financial Institutions, and the IFSB, Islamic Financial Services Board, play a vital role in developing and promoting prudential and governance standards tailored for Islamic financial institutions. And countries like Malaysia are highlighted as having made significant progress in developing sophisticated and well-regulated Islamic banking sectors alongside their conventional systems.
Very interesting. Finally, when we're talking about emerging economies, we unfortunately can't ignore the recurring issue of sovereign debt crises.
No, sadly, they have been a recurring feature of the international financial landscape. Mexico's crisis back in 1982, triggered when it couldn't repay its debts, was a major shock to the system.
And have things changed since then?
Well, the nature of emerging market finance has evolved. There's been a shift away from bank loans being the dominant form of finance towards countries issuing more debt in the form of bonds, debt securities, traded in markets, and also having more active equity markets. But crises still happen.
Like Mexico again in 1994.
Exactly. The Mexican peso crisis of 1994-95 showed that vulnerabilities definitely still existed, related to exchange rate policies and short-term debt. The international response to that crisis was significant, involving a large package coordinated by the U.S. government, the IMF, and the Bank for International Settlements, BIS, highlighting just how interconnected global finance had become.
Is there any way to predict these crises?
Well, there's ongoing research into developing early warning systems, EWS, that try to use economic indicators to predict when countries might be at high risk of defaulting on their sovereign debt. But prediction is notoriously difficult.
I can imagine. And the source mentions Russia again in the context of privatization.
Yes, it offers a contrasting experience, noting that the way privatization unfolded in Russia in the 1990s led to the rise of powerful bank owners, sometimes referred to as oligarchs, who gained control of significant assets. It also highlights the ongoing difficulties in dealing with non-performing loans in transition economies and the continued dominance of large state-owned banks like Sberbank in Russia.
It's a stark reminder that the path of financial development isn't always smooth, and the outcomes can vary dramatically depending on the specific context and policies.
Absolutely. Now that brings us nicely, perhaps grimly, to the critical topic of bank failures and broader financial crises. History is unfortunately littered with examples, and there are definitely some important, often painful lessons to be learned.
Right. Let's dive into some of those historical episodes. The U.S. savings and loan crisis of the 1980s seems like a major one.
It was huge. The S&L crisis had multiple causes. There was rapid, poorly supervised growth in the industry following some deregulation. There were instances of outright fraud and mismanagement. And crucially, that moral hazard issue we discussed, created by deposit insurance, played a significant role. It incentivized excessive risk-taking by many S&L owners.
And the cleanup was massive.
Enormous. The government's response involved passing a FRIA, dissolving the Insolvent Insurance Fund, FSLEC, and creating a new agency, the Resolution Trust Corporation, RTC, specifically to manage and sell off the assets of hundreds of failed savings and loan institutions. The cost to taxpayers was substantial.
Then we had the BCCI scandal. That was international, wasn't it?
Yes, the Bank of Credit and Commerce International, BCCI, was a major international bank failure in the early 1990s. It wasn't just about bad loans. It involved widespread fraud, money laundering on a global scale, and operations structured in a deliberately opaque way across many different countries to evade effective regulation.
A real wake-up call about the challenges of supervising banks that operate globally.
Absolutely. It really highlighted those difficulties. The UK also had its own share of banking troubles domestically, even before the global crisis of 2008. The source mentions the secondary banking crisis back in the mid-1970s.
Which led to the 1979 Banking Act we discussed.
Exactly. And also a crisis involving some smaller banks in the early 1990s, where the Bank of England had to step in again with its lender of last resort function, providing emergency liquidity support.
And it wasn't just the UK and the US, right? These things happen elsewhere, too.
Oh, definitely. Our source provides examples of significant bank failures and government interventions requiring bailouts or rescues in countries like Spain, Penesto, Norway, Canada. Two smaller banks failed in the 80s, and of course Japan, which we'll get to. It also notes that bank failures often seem to cluster together in certain periods, often linked to economic downturns or the bursting of asset bubbles.
Which brings us back to deposit protection schemes. They're vital for preventing widespread panic and bank runs when individual banks fail.
Absolutely, they promote stability in that sense.
But they also come with that inherent moral hazard risk we keep mentioning. Have regulators tried to tweak them to reduce that risk?
Yes. The introduction of risk-based premiums by the FDIC in the U.S., which we touched on earlier, is one key example. The idea is to make riskier banks pay more for their deposit insurance, theoretically giving them an incentive to operate more prudently. Another concept mentioned is co-insurance.
Co-insurance, like in health insurance.
Sort of. The idea would be that depositors, perhaps only those with very large deposits above the insured limit, would bear a small percentage of any loss if their bank fails. The theory is that this would give them some incentive to monitor their bank's health. It's a controversial idea because you don't want to undermine the basic confidence that deposit insurance provides.
Tricky balance again. And when economists have studied why banks fail, what are the common factors?
Studies that have looked at this empirically, using statistical models, often point to declining profitability as a key leading indicator of failure. And that falling profitability is frequently driven by deterioration in the quality of the bank's loan portfolio, basically. More and more borrowers struggling to pay back their loans.
So bad loans are often at the heart of it.
Very often, yes. Now, moving into the late 1990s, the Asian financial crisis was a major regional event that had global repercussions. What were the main issues there, particularly in places like Korea and Indonesia?
Yeah, that crisis hit hard and fast.
It did. The crises in countries like South Korea and Indonesia were particularly severe. Key vulnerabilities included high levels of external debt, often denominated in foreign currency, and with short maturities, making them vulnerable to shifts in investor sentiment. When capital flows reversed and their currencies plunged in value, it became incredibly difficult to repay those foreign debts.
And were there problems within their banking sectors too?
Absolutely. In Indonesia, for example, the source highlights a rapidly growing banking sector that had weak supervision and regulation. A major problem was connected lending banks lending excessively to companies owned by the same people who own the bank, often without proper risk assessment. When the crisis hit, many of these loans went bad very quickly, leading to widespread bank failures. The International Monetary Fund, the IMF, played a very significant and sometimes controversial role in providing financial aid packages conditional on implementing major economic and structural reforms.
And Japan's banking crisis, that was different, wasn't it? It seemed to last for a very long time after their huge asset price bubble burst in the early 90s.
Indeed. Japan's experience was often described as a long, slow-burn crisis. The collapse of the enormous bubble economy, particularly in stock prices and real estate, left Japanese banks saddled with a mountain of non-performing loans, NPLs.
And dealing with those bad loans was slow.
Extremely slow for various reasons. The source mentions the close, often opaque relationships between banks and their affiliated corporate groups, the keiretsu, which sometimes made it politically difficult to force restructuring or recognize losses. There was also perhaps a regulatory culture of forbearance, hoping that economic recovery would eventually solve the problem.
It didn't really.
Not quickly enough. The NPL problem festered for years, acting as a drag on the entire Japanese economy. Eventually, though, reforms were put in place. The Financial Supervisory Agency, FSA, was created, taking over banking supervision from the powerful Ministry of Finance. New measures like prompt corrective action were introduced, aimed at forcing banks to deal with their capital adequacy problems more quickly and transparently. The Bank of Japan was also made more independent, but it was a long and painful process.
In contrast, the source mentions the banking crisis in Sweden around the same time, early 1990s, had a much faster resolution.
Yes, the Swedish response is often cited as a contrasting example of swift and decisive government action. When their property bubble burst and banks faced huge losses, the Swedish government stepped in very quickly and forcefully.
How so?
They provided a 100% guarantee to the creditors of the major banks to prevent panic. They took over two of the largest troubled banks, Gota Bank and Nordbanken, effectively nationalizing them temporarily. They set up asset management companies, bad banks, to take over the non-performing loans and manage them separately. This very strong signal of government support and the rapid cleanup of bad assets is credited with helping the Swedish banking system and economy recover relatively quickly compared to Japan.
Interesting contrast. Finally, in this rogues gallery of crises, we have the case of Long-Term Capital Management, or LTCM, in 1998. This wasn't a traditional bank failure, was it? It was a hedge fund.
Correct. LTCM wasn't a bank. It was a very large, very prestigious hedge fund run by Nobel Prize-winning economists and star Wall Street traders. But its near collapse sent shockwaves through global financial markets and required a highly unusual intervention.
What was LTCM doing?
They specialized in complex arbitrage strategies, trying to profit from tiny, temporary discrepancies in the prices of related securities across global markets. They believed their sophisticated mathematical models, including VAR, could manage the risks involved.
Something went wrong.
Spectacularly wrong. They were incredibly highly leveraged. They had borrowed enormous amounts of money relative to their own capital to amplify their bets. When Russia defaulted on its domestic debt in August 1998, it triggered unexpected turmoil across many global markets. Suddenly, many of LTCM's seemingly diversified, low-risk arbitrage positions all started moving against them simultaneously in ways their models hadn't predicted.
The correlations broke down.
Exactly. Correlations went to one, as they say. They faced massive losses and were on the brink of collapse. The concern was that if LTCM failed abruptly, it would be forced to liquidate its huge positions in illiquid markets, potentially causing a fire sale that could destabilize major banks and financial institutions that were its counterparties or lenders.
So the Fed stepped in.
The Federal Reserve Bank of New York didn't bail out LTCM directly with public money, but it played a crucial role in orchestrating a private sector bailout. It brought together the heads of the major Wall Street firms that were exposed to LTCM and essentially strong-armed them into injecting new capital to prevent a disorderly collapse.
A privately funded rescue, but organized by the Fed. What were the lessons learned from LTCM?
Several key lessons. One was about the limits of arbitrage. Even seemingly small price discrepancies can persist or widen dramatically under stress. Another was about the dangers of excessive leverage. And perhaps most importantly, it highlighted the risks of crowded trades and correlated positions, showing how even sophisticated risk models like VAR could fail spectacularly when underlying assumptions break down in a crisis. It also raised questions about the implicit too big to fail problem, extending beyond traditional banks to highly interconnected non-bank financial institutions.
All these crises really underscore again and again how important it is to have both effective regulation and strong internal risk management practices in place, and also perhaps a degree of humility about our ability to predict and control financial markets.
Well said. The source also briefly touches on the role of the IMF in global crises, noting that while its financial resources are limited compared to domestic central banks acting as lenders of last resort, it still plays a central, albeit sometimes controversial, role in coordinating international responses and providing conditional financing.
Okay. Now, let's move on to a slightly different but related topic. How do we actually measure efficiency and competition in the banking sector itself? How do you even determine if one bank is performing better or is more efficient than another?
That's a really important question for economists and regulators. There are a couple of main ways economists think about measuring bank output and efficiency. One is the intermediation approach.
Intermediation, like their core function of connecting savers and borrowers.
Exactly. This approach views the bank's main output as its assets, primarily the loans and investments it makes. So efficiency is measured based on how well it uses its inputs, like labor and capital and deposits, to generate those earning assets.
Okay, what's the other main approach?
The other is the production approach. This sees banks more like factories producing financial services. Their outputs are things like the number of deposit accounts maintained, the number of loans processed, the number of transactions handled. Efficiency here is about minimizing the cost of producing a given volume of these services.
So two different ways of looking at what a bank actually does. And then there's this concept of X efficiency.
Right. X efficiency, or maybe more accurately, X inefficiency, refers to deviations from the absolute best possible performance, even given the technology available. It has two main components.
For sure.
First, technical inefficiency. This means the bank simply isn't getting the maximum possible output from the inputs it's using. It's operating below the efficiency frontier, maybe due to wasteful processes or poor management.
Okay, just not being very productive.
Right. The second component is allocative inefficiency. This means the bank might be technically efficient getting the most out of its inputs, but it's using the wrong mix of inputs given their relative prices, maybe using too much expensive labor and not enough technology, for example.
So X efficiency is about being both productive and using the right combination of resources.
Exactly. Getting onto the efficiency frontier and being at the right point on it.
And what are the actual techniques that economists use to try and put a number on this efficiency, to compare banks?
Broadly, there are two main categories of techniques mentioned in the source. Parametric methods like stochastic frontier analysis, SFA, use statistical techniques, econometrics, to estimate an ideal efficiency frontier based on the data, and then measure how far each bank is from that frontier, while also trying to account for random noise or luck.
Okay, statistical modeling.
Yes. And then there are non-parametric methods, with data envelopment analysis, DEA being the most common. DEA uses linear programming techniques. It doesn't assume a specific mathematical form for the production process, but instead constructs a best practice frontier based on the actual performance of the most efficient banks observed in the sample. It then measures the efficiency of other banks relative to those best practice peers.
So different methodological approaches to try and measure the same underlying concept.
Pretty much. Both have their strengths and weaknesses. Now, what have studies using these techniques actually found about efficiency in banking? Specifically, about whether bigger banks are generally more efficient economies of scale, or if banks benefit from offering a wider range of services economies of scope.
Yeah, is bigger better? And is being a universal bank more efficient?
Well, the findings presented in the source, particularly drawing on studies from the US and Europe, have been somewhat mixed and have evolved over time. Some earlier studies, particularly those looking at US banks in the 1980s when there were more restrictions, often found evidence of economies of scale for smaller banks, meaning they could become more efficient as they grew larger, up to a certain point.
But only up to a point.
Yes. These studies often suggested that very large banks might actually start to experience diseconomies of scale, becoming less efficient as they got bigger, perhaps due to bureaucracy or complexity. Restrictions like Glass-Steagall might also have played a role, preventing large banks from achieving potential economies of scope by combining commercial and investment banking.
What about economies of scope being more efficient by offering many different products?
Research on scope economies has also yielded varying results. Some studies suggested that for certain types of institutions, like maybe savings banks, trying to diversify into too many different product lines might actually lead to inefficiencies or diseconomies of scope. However, the source also notes that more recent studies, particularly looking at European universal banks in less restrictive regulatory environments, have sometimes found more evidence supporting the existence of both scale and scope economies, suggesting larger, more diversified banks can be more efficient in some contexts.
So the answer seems to be it depends on the size, the type of bank, the regulatory environment.
That seems to be a fair summary, yes. There's no simple universal rule. Now, the relationship between how the banking market is structured, things like how many banks there are, how concentrated the market is, and how well banks perform in terms of pricing and efficiency, has also been a really big topic of debate among economists and policymakers.
Right. Does having only a few big banks automatically mean less competition and worse outcomes for customers?
That's the core of the debate. There are different schools of thought here. One is the traditional structure conduct performance, or SCP, paradigm.
SCP, yeah.
The SCP view basically argues that market structure, like high concentration, determines bank conduct, less competitive pricing or innovation, which in turn leads to poorer performance, like higher profits for banks but higher prices for customers. So under this view, high concentration is generally seen as bad for competition and efficiency.
Okay, concentration leads to poor performance. What's the alternative view?
The alternative is often called the efficient structure, or ES hypothesis. This view flips the causality. It argues that it's not that concentration causes poor performance, but rather that banks that are more efficient, perhaps due to better management, superior technology, or economies of scale, will naturally capture a larger market share and potentially earn higher profits.
So good performance efficiency leads to concentration.
Exactly. The ES hypothesis suggests that market structure is actually an outcome of underlying differences in bank efficiency. For example, one version, the relative efficiency hypothesis, or X-efficiency version, suggests that banks with better management or technology simply have lower costs, allowing them to gain market share and potentially higher profits, irrespective of market concentration itself. Another version focuses more on scale efficiency.
And the implications for how governments should regulate banks are quite different depending on which of these views you believe is more accurate.
Hugely different. If you believe the traditional SCP view, then it might make sense for antitrust regulators to be quite aggressive in preventing bank mergers and trying to keep markets relatively fragmented to promote competition.
But if you believe the efficient structure view,
Then interfering too much with market structure, like blocking mergers between efficient banks, might actually hinder efficiency gains and potentially harm consumers in the long run. Under the ES view, the policy focus should perhaps be more on ensuring that markets are open to entry and that banks are encouraged to be efficient, letting the market structure evolve as a result.
it's a fundamental debate with real policy consequences. The idea of contestable banking markets also plays into this discussion about competition, doesn't it?
Yes, absolutely. The theory of contestable markets argues that even if a market currently has only a few incumbent firms, it can still behave competitively if the threat of new firms entering the market is credible and strong.
So potential competition matters as much as actual competition.
Exactly. If potential entrants can easily come in, grab market share, and leave again without incurring huge sunk costs, then the existing banks might be forced to keep their prices low and operate efficiently to deter that entry, even if there are only a few of them currently in the market.
How do economists try to measure how contestable or competitive a banking market actually is?
One commonly used technique mentioned in the source is calculating the Panzer-Ross, or PR statistic, sometimes called the H statistic. This looks at how responsive a bank's total revenues are to changes in its input prices, like the cost of funds or labor. The theoretical argument is that the size of this response can indicate the degree of market power banks possess.
And what have studies using this PR statistic generally found for banking markets?
Studies cited in the source, looking at markets like the US and Canada, have often found results consistent with monopolistic competition, rather than perfect competition or pure monopoly,
Monopolistic competition.
meaning a market where there are quite a few players, but each offers slightly differentiated products or services, giving them a small degree of market power, but where there's still significant competition and markets are at least somewhat contestable. So not perfectly competitive, but not a cartel either.
Okay. And what about the impact of mergers and acquisitions, M&As, on how well banks actually perform? This is something we see happening all the time in the financial world, banks buying other banks.
It's a constant feature, yes. Again, the evidence on the effects of M&As is somewhat mixed and depends on what you measure and where you look.
For instance, what happens to the stock prices of the banks involved?
Well, some studies looking at European bank mergers, mentioned in the source, have actually found that the stock price of the acquiring bank tends to go up slightly around the time the deal is announced. This is interesting because many studies in the U.S. have often found the opposite, that the acquirer's stock price tends to drop, suggesting maybe the market thinks they overpaid or the merger won't create value.
Why the difference between Europe and the U.S. findings?
The source speculates it might be related to the relative size of the deals or perhaps different regulatory environments or market structures. It's not entirely clear.
And what about the impact on customers? For example, what happens to the interest rates banks charge on loans after a merger?
Studies looking at loan rates post-merger have also had varying results. Some research suggests that in markets where there's a lot of geographic overlap between the merging banks, meaning they were direct competitors before the merger, and the bank being acquired is relatively small, loan rates might actually go down after the merger, possibly due to efficiency gains.
Oh, so mergers can be good for borrowers sometimes.
Potentially, in some circumstances. However, other studies have found that in different situations, perhaps involving larger targets or less market overlap, loan rates might actually increase, suggesting that the reduction in competition outweighs any efficiency gains.
So again, no easy answer to whether bank mergers are always a good or bad thing for efficiency or competition. It really seems to depend on the specific circumstances of the deal and the market.
That seems to be the most accurate conclusion, yes.
Yeah.
It requires careful analysis on a case-by-case basis. Now, to make some of these abstract ideas about strategy, risk, and regulation a bit more concrete, our source includes some really interesting specific case studies of individual banks. Shall we touch on a few of the highlights?
Definitely. Bringing it down to specific examples is always helpful. Where should we start? Goldman Sachs.
Sure. The Goldman Sachs story highlights a major strategic shift for many investment banks, moving more heavily into proprietary trading, that is, trading for the bank's own profit using its own capital rather than just executing trades for clients.
A potentially much more profitable, but also riskier business.
Exactly. The case describes Goldman's success in building a dominant position in the European market for trading large blocks of shares, block trading. It also hints at the internal tensions that can arise within these firms between the traditional investment bankers who advise clients and the traders who are focused on market bets.
And there was that example of a specific profitable trade.
Yes, the profitable trade they made in UK government bonds, gilts, after an unexpected election result, really illustrates the potential for huge gains from correctly anticipating market moves, but implicitly also underscores the significant risks involved if those bets go wrong.
Okay. What about Kidder Peabody? That story didn't end so well.
No, the Kidder Peabody case, specifically the bond trading scandal involving a trader named Joseph Jett in the early 1990s, serves as a stark warning. It highlighted the dangers of potentially weak internal controls, relying too heavily on supposedly star traders, and the catastrophic losses that can occur, especially when combined with high gearing or leverage. Ultimately, the scandal and underlying issues led to the firm being sold off to PaineWebber.
A cautionary tale about risk management and oversight. Now, looking back at Japanese banking again, but maybe through the lens of their post-bubble struggles.
Right. Revisiting the Japanese banking situation provides a long-term perspective on the immense challenges of dealing with the aftermath of a massive asset bubble bursting. We see the Ministry of Finance, MOF, engaging in gradual, sometimes reluctant, deregulation, often in response to international pressure. We see the unique phenomena of sci-tech Japanese companies engaging in speculative financial engineering during the bubble years.
And those close relationships within the Keiretsu groups played a role too.
Yes. The source emphasizes how those close, often cross-shareholding relationships within corporate groups made it difficult to deal decisively with bad loans, as banks were reluctant to pull the plug on affiliated companies. The ongoing, slow efforts at restructuring and consolidation, like the merger that eventually created Sakura Bank, which later became part of SMBC Group, were all part of this long adjustment process.
What about Bancomer in Mexico? That case ties into emerging markets and crises.
Exactly. The acquisition of Bancomer, a major Mexican bank, by BBVA of Spain during the 1994-95 peso crisis, provides a great case study. It highlights the strategic considerations for a large foreign bank deciding whether and how to enter a volatile emerging market during a time of crisis.
Yeah.
What opportunities does it present? What are the risks?
And it touches on issues specific to emerging markets.
Yes, it brings up again the issue of connected lending, which can be prevalent, and also shows very clearly how sovereign events like a currency crisis can dramatically impact the credit ratings and stability of even major domestic banks.
Then there's Credit Lyonnais, a French bank with a troubled history.
Very troubled. The saga of Credit Lyonnais is a compelling and cautionary story about the potential pitfalls of heavy state influence and ownership in banking. It details the massive accumulation of losses the bank suffered in the early 1990s, partly due to risky expansion and investments.
And the government had to step in.
Massively. It required huge government rescue plans and bailouts. The case study discusses the controversial creation of a bad bank structure to hive off the non-performing assets, and also touches on other controversial episodes involving subsidiaries like Executive Life and Altus Finance, which led to legal disputes later on. It's a complex story of mismanagement, political influence, and costly state intervention.
What about Continental Illinois in the U.S.? That was an earlier crisis, wasn't it?
Yes. The run on Continental Illinois back in 1984 was a major event in U.S. banking history. It was triggered by the collapse of a smaller energy lender called Penn Square Bank, to which Continental Illinois had bought a lot of loans. Concerns about the quality of those loans and Continental's overall health led to a massive run by depositors and other funding providers.
And the government response?
The government, through the FDIC, effectively stepped in and guaranteed all of the bank's liabilities, not just the insured deposits, to prevent the run from spreading to other major banks. This response is often cited as one of the earliest clear examples of the implicit too big to fail policy in practice, even before the term became widely used. The bank was effectively nationalized for a period.
And Bankers Trust, they were known for derivatives, right?
Yes. Bankers Trust represents another interesting strategic evolution. They shifted away from traditional commercial lending towards focusing on wholesale corporate banking, trading, and particularly the burgeoning market for complex derivatives in the late 80s and early 90s.
But they got into trouble with that.
They did. The case study highlights the scandals that erupted when it emerged that Bankers Trust had allegedly misled some corporate clients, like Gibson Greetings and Procter & Gamble, about the risks and potential losses involved in complex swap transactions they had sold them. This led to lawsuits, significant regulatory scrutiny and fines, and ultimately forced the bank to reorient its strategy and culture. It really underscores the risks, both financial and reputational, associated with pushing the envelope in complex financial instruments, and the critical importance of ethical behavior and clear client communication.
Finally, Deutsche Bank and their ambitions.
The Deutsche Bank case study focuses on their ambition, particularly around the turn of the millennium, to become a truly global, top-tier universal bank with a very strong investment banking arm, aiming to compete head-to-head with the big U.S. investment banks. It discusses the ultimately aborted merger attempt with Dresdner Bank.
Why did that merger fail?
The case illustrates the significant strategic challenges and, importantly, the internal cultural resistance that can arise when trying to combine two large institutions with different strengths, business models, and compensation structures, particularly integrating a large commercial bank with a more aggressive investment banking culture.
These case studies really do provide valuable, concrete, real-world context for all the broader trends and theoretical ideas we've been exploring today. Makes it much more tangible.
I agree. They show how these concepts play out in the messy reality of the financial world.
They certainly do. So as we bring this pretty comprehensive deep dive to a close, what would you say are the most important things for you, our listener, to take away from our discussion today? Boiling it all down again.
Gosh, okay. Well, I think first and foremost, it's clear that banking is an incredibly complex and deeply interconnected industry. Those core functions we started with, connecting savers and borrowers, providing that vital liquidity, facilitating payments, they're all fundamentally intertwined.
Right, you can't really separate them.
Not easily, no. Second, risk is just a constant inherent presence. Banks are in the business of managing risk, and they face a really wide spectrum of potential threats, from credit losses to market swings to operational failures.
And regulation is key.
Absolutely. Regulation plays a vital, if sometimes imperfect, role in shaping how the industry operates, trying to ensure stability and protect customers. But it also faces inherent challenges, like that moral hazard problem we kept coming back to.
And the industry is always changing.
Constantly. The world of banking is incredibly dynamic. It's always evolving in response to new technologies, shifting competitive pressures, regulatory changes, and very often the hard, painful lessons learned from past financial crises. That seems to be a recurring driver of change.
Yeah, learning from mistakes, hopefully. And if we were to highlight one really striking aha moment from our discussion, maybe something counterintuitive.
Perhaps just the sheer, almost unimaginable scale of that off-balance sheet derivatives market we mentioned right at the start. The fact that its notional value could dwarf the traditional assets that banks hold on their balance sheets.
Yeah, that $165 trillion number.
Right. It really emphasizes how the nature of financial activity and risk has evolved in the modern era, moving far beyond simple lending and deposit taking. It underscores the complexity and the potential for hidden interconnections within the financial system that regulators and banks themselves struggle to fully grasp sometimes.
That's a great point. Really highlights the complexity. So why should you, our listener, even if you don't work in finance, actually care about all of this stuff? Why does it matter?
Because fundamentally, the health and stability of the banking system underpins so much of our collective economic well-being. Whether you're running a business, saving for retirement, buying a house, or just using your debit card, the banking system facilitates it all.
So understanding it helps us understand the world around us better.
Exactly. Understanding these fundamental principles helps you make better sense of the financial news you hear every day. It helps you understand the financial products you might use. And it helps you grasp the broader economic forces and policy debates that shape our lives and our futures.
Absolutely. It's really about being an informed participant in the modern economy we all live in. And on that note, maybe we can leave our listeners with something to really think about, a food for thought question building on what we've discussed.
Sounds good.
Okay, so here it is. Given this long, and let's be honest, sometimes turbulent history of financial crises that we've touched on, and considering the ongoing innovation in financial instruments, markets, and now technology like fintech and maybe even digital currencies, What future innovations or perhaps regulations do you think will be the most critical in trying to ensure long-term financial stability? It's a question that regulators and bankers grapple with constantly, and one we definitely encourage you to consider.